Good afternoon, everybody. Uneducated Economist here. Thought I'd talk a little bit more about the Federal Reserve and their new monetary policy, talking about inflation and how they're going to deal with inflation. Typically, the Federal Reserve would want to keep their target inflation rate around 2%. Apparently, 2% is like the magical number that is good for the economy, good for economic growth, good for the stability of the nation as a whole. I don't know where they came up with this 2%, but apparently 2% is it, and that's what they're shooting for as far as an inflation target. Now, something that's very interesting when we talk about inflation, when you listen to inflation coming from the mainstream media or coming from just about anywhere where you're getting statistics, they're talking about price inflation. And most of the time they're talking about consumer price inflation. But inflation as definition, like if you listen to guys like Peter Schiff and the like, the true definition of inflation is expansion of the money supply and credit. So inflation is already here. It's just that we're not seeing it in the consumer prices. We're seeing it in the asset prices, stocks, bonds, real estate. So the Federal Reserve, they're keeping their eye on those consumer prices. And when they see those consumer prices start to inflate, see the inflation in the consumer prices, that's what they're talking about when they say that we want to see a 2% inflation, or say let it run hot. Because this is the new idea, is that they're going to let inflation run hotter than what they would typically target for. Because inflation has been running under their 2% target for so long, now they're going to go for average inflation as opposed to just target inflation. So as the years go on here, we can expect inflation to rise and then rise above that 2% and expect the Federal Reserve to do nothing about that, to go an extended period of time at ultra low interest rates. And see, now the Federal Reserve, when they judge this inflation, and remember, it's not inflation like the money printing like definition, we're talking about price inflation. When they see this inflation prices start to kick up, it's usually at a time when there's very low unemployment. When the jobs numbers are looking really good, like we have the best jobs numbers in history, that's when the Federal Reserve starts looking towards inflation starting to heat up. They think, okay, well, we got low job number, a lot of people are working, a lot of money flowing through the system. This is the time that we would expect inflation to start running hotter, and that interest rates would start to rise. This is a reason why a lot of times if you go back and you look at a chart of unemployment, like the Federal, I'll go and find one, I'll leave it down in the description for you guys. But like the Federal Reserve chart of unemployment, if you notice, if you look at there is a huge significant drop in unemployment prior to every recession. More jobs just before the recession kicks in. Because what would happen is that the Federal Reserve would look at these jobs, seeing the strong jobs market, think, okay, inflation is on its way, we need to start raising interest rates. And every time the Federal Reserve raises interest rates, they raise them into the recession. It causes the recession to take place. Every time. Go and look. I mean, even just in the last of this recession, they were raising rates. They were doing autopilot. Remember, they were going to raise, every quarter they were going to raise the federal funds rate another quarter point, another 0.25%. And they were going to do this until, I guess, they've achieved their objective. They barely got anywhere, and they had to immediately reverse course. After they reversed course, it was within months, right? Within, I don't even know what the exact date is, but like 6 months later, we're hit with the recession. Of course, it wasn't had anything to do with anything other than the COVID, so they say. But yet, if you just go back and you look at the history of the Federal Reserve and the raising of interest rates and how it leads into a recession every time they do it, this one was no different. But yet, we don't blame it on the rising of interest rates at the Fed funds rate. We blame it on COVID, because that's the reason. And so now you listen to these guys, these Federal Reserve, and there was probably 4 or 5 presidents came out and gave a statement over the last couple of days. In fact, there was probably more. I'm going to leave a link down in the description. I think I had 3 or 4 articles or something talking about different Fed presidents all pretty much saying the same thing, that if we see another uptick in cases of COVID and a lockdown takes place, we would go into another double dip recession. In fact, some of them are saying that we may face a double dip recession anyway. All of them are saying that we're going to let inflation run hot, hotter than they normally would with the 2% target, but let it actually run over 2% for a while. But the jobs numbers won't be back for a couple of years. The historic low unemployment. They expect it again, but not for many years. So even by their own statement, if you think about this, the Federal Reserve expects inflation when they have very low unemployment. They don't expect very low unemployment for a number of years out down the road. They're going to maintain low interest rates for as long as they need to in order to achieve the long-term average inflation rate of 2%. It sounds to me like the Federal Reserve is backed into a corner right now because they all say the same thing, that it's going to take fiscal stimulus coming from the government to pull this thing out of the hole. The Federal Reserve is out of bullets. They don't really have anything to use anymore. They used to drop interest rates. They would drop interest rates around 5%, and this would help. This would lead to a recovery out of the recession. They couldn't go anywhere anymore. They're down at zero. There is no more dropping of interest rates. They're out of bullets. So I got to thinking about this a little bit, and I was just like, okay, so this is the question I've raised before. If the Federal Reserve could not obtain a 10% inflation rate a 2% inflation rate for the last 10 years, then what leads them to believe that they're going to be able to achieve any kind of inflation going into the next few years? I mean, what is it that they plan on doing? Because all the past tools, I don't feel is going to be a benefit to the bringing of inflation, price inflation, all right? Not inflation in money like we would talk, but price inflation to the consumer prices like the Federal Reserve is expecting, because it hasn't happened yet. For 10 years now, they have printed up more money than they have ever done before, injected that into the banking system, and it landed everywhere but the consumer prices. So they say, judging by their statistics. It landed in bonds, it landed in stocks, it landed in real estate. But so far, the consumer prices seem to be lagging as far as the increase goes. So the Federal Reserve could achieve their inflation target simply by looking at inflation or price inflation the way they judged it just a few years ago, say 10 years ago, or 20 years ago, or 30 years ago. So they want to talk about how this is the best jobs number, or prior to the recession, but we just recently had the best jobs numbers since the 60s. But they don't want to go back and judge inflation by the way they judged it back in the 60s. But they do want to compare the unemployment numbers compared to back then. You see, if they jive the numbers right, it makes it look correct for their agenda, then that's the correct numbers. But if you go to shadow stats and you try and bring up those numbers, say, hey, how about we judge inflation the way you used to do it, then we would have your 2% objective. In fact, we would be far above that. Why don't we just judge it the way you used to judge it and compare it to that, instead of saying, hey, we're going to take away all these elements that causes the consumer prices to rise, and this is how we're going to judge inflation instead, by manipulating the numbers, and then tell you the inflation that was back in the 60s, 70s, 80s, 90s, going up until 2000, and then compare these numbers to those numbers, even though they judged them differently back then. So the Federal Reserve, if they want their 2% inflation, all they have to do is just go and just adjust the numbers and look at them the way they used to look at them in the past. And then they would obtain their 2% inflation target, the consumer prices. Does any of that make sense? So, on top of all this, if we just think about the inflation part of it, what is inflation? It's increase in money supply. It's increase in money supply and credit. But what is the effect on the dollar? Well, it weakens the dollar. They even say it. We want a weaker dollar. We want to increase our exports, make our exports more affordable for the rest of the world out there. We want a weaker dollar. Well, if you have a savings account, that is damaging. That is very damaging to somebody who has a bank account, who has savings, who does not invest. Inflation kills that person. It kills the responsible saver. So when you read all these articles coming from the Federal Reserve, coming from all these economists out there talking about how we're going to have higher inflation, on how we're going to, keep interest rates ultra low for longer period of time, how we may be even facing another double dip recession, or all these articles are coming out talking about this stuff. And it just worries the hell out of most people when it comes to their money. They're thinking, I got to do something with it. I can't keep my $10,000 in cash or in my bank account. I got to invest it somewhere else. I'm going to lose it to inflation. But yet the ultra rich are still getting into cash. I'll leave a link down in the description for you guys to an article talking about the, Tiger 21? Is that the name of it? This is the group of like 800 investors, ultra rich, multi-million dollar investors, and they are saying that their cash holdings prior to the COVID lockdown and all the other crap that went down was around 12% at the beginning of this. Right now, it's sitting at 19%. Their cash holdings are increasing dramatically. The ultra rich, they're getting into cash. Makes you wonder why, doesn't it? During a time when the mainstream media and everybody else out there, all these economists, are pushing the fear of inflation, of price inflation, and a weakening dollar out there, saying how it's going to just devastate the dollar, it's going to kill the dollar, the ultra rich are getting into cash. Now, isn't that something? Uneducated Economist. You guys let me know.